So, welcome to this deep dive, everyone. I'm really glad you're joining us today.
Yeah, we've got a really fascinating one lined up for you.
We absolutely do. And look, our mission here on this specific Talk Tickers breakdown is, it's pretty straightforward. We want to cut through all the corporate jargon.
Right, get past the fluff.
Exactly. We want to give you a really data-forward, opinionated, and totally actionable summary of MGIC Investment Corporation. That's ticker symbol MTG, by the way.
MTG, right. And we're specifically looking at their Q4 2025 earnings call.
Yep. And we're going to try to unpack all of this, give you the absolute core takeaways, and figure out what it actually means for your portfolio. So, setting the stage here, the American housing market is, well, it's completely frozen.
Oh, it's stuck in amber.
Stuck in amber. I mean, that is the consensus narrative right now, right?
Yeah.
You look around your neighborhood and nobody is selling their home.
Nobody. Because they're terrified of losing that legacy 3% mortgage rate.
Exactly, the golden handcuffs. And then on the flip side, very few people are buying because, well, mortgage rates are elevated, inventory is basically non-existent, and affordability is just. I mean, it's arguably at a generational low.
Yeah, it's a brutal environment for a home buyer.
It really is. So the entire ecosystem just feels gridlocked. Yet somehow, in the middle of all this, we have MTG, a company that relies entirely, like 100% on the flow of the mortgage market.
Right. Their whole business is private mortgage insurance, or PMI.
Yeah, PMI. And they just reported that they increased the tangible net worth of their business by 13% in a single year.
Which is wild.
It's completely counterintuitive. So today we are turning on the lights to see exactly how MTG engineered that reality. We're going to hit the headline numbers, the story behind them, management's guidance, and finally, the bottom line for you as a retail investor.
Yeah, because it's one of the most fascinating paradoxes in the market right now, honestly. You have this macro environment that on paper should just be a brutal headwind for anyone in real estate.
Right.
But then you look at MTG's Q4 2025 call, and you see a business that isn't just surviving this frozen market. They are mathematically extracting more value out of it than ever before.
Okay, let's unpack this, because I want to get straight to the data forward delivery. Let's fire off the core headline numbers for the fourth quarter.
Let's do it.
So net income for Q4 came in at $169 million. That is P75 cents per diluted share. And just for context, that's up from 72 cents in Q4 of the prior year.
Right, so solid quarterly growth.
Yeah. And then if you look at the full year, the whole of 2025, net income was $738 million, or 3.14 cents per share.
Which is a massive number when you think about the volume constraints in the housing market.
Totally. And that drives their return on equity, the ROE, to 13% annualized for the quarter and an incredibly strong 14.3% for the full year.
Yeah, hitting mid-teens ROE in the financial sector is elite. It really is.
Right. But here is the number that really jumps off the page for me. Book value per share hit $23.47. That is a 13% increase year over year. Plus, their total insurance in force surpassed $303 billion.
Up 3% from last year.
Right, up 3%. So I got to push back on this a little bit. A 13% bump in book value sounds amazing on a spreadsheet, but are these numbers genuinely strong? Or is this just some kind of accounting mirage in a fundamentally broken housing market?
Well, it's definitely not a mirage. It's real value creation. And to understand why, you kind of have to translate book value into plain language, especially for retail investors who are maybe used to trading tech stocks.
Yeah, because tech investors don't even look at book value.
Exactly. They look at revenue multiples, user growth, things like that. But in the insurance space, book value is basically the holy grail. It's the net worth of the company per share.
So they just shut down the business tomorrow.
Right. If they stopped writing policies, paid off all their debts, settled every expected insurance claim, and just liquidated everything, book value is the actual cold, hard cash you'd get for every share you hold.
Okay, so it's a very tangible metric.
Very tangible. And growing that net worth by 13% while maintaining an 85% persistency rate?
Wait, 85% persistency? That just means 85% of their existing policies stayed on the books, right? Yeah. No one canceled.
Exactly. People aren't moving, so they aren't canceling their PMI. And because of that, MTG is entering 2026 from a true position of strength, just like their CEO, Timothy Matkey, claimed on the call. The existing book is just wildly profitable right now.
Okay, so that perfectly links the strong bottom line to how they actually achieved it.
Yeah.
Because the story behind the numbers is where things get really interesting.
Yeah, the operational mechanics are fascinating.
So we know top line new business was $17 billion for the quarter. and $60 billion for the whole year, which is an 8% increase. But there was this other line item that caught my eye.
The reserve release.
Yes. They got a surprise $31 million boost to the quarter from, and this is the quote, favorable loss reserve development.
Right.
Now, normally people just say, oh, it's like a rainy day fund. I hate that analogy. Think of loss reserves more like a casino risk desk.
Oh, I like that. Run with that.
Right. So if you're a casino and you take a bunch of bets, you have to lock away a certain amount of cash because statistically, someone is going to win, right? You need the money to pay out.
Yeah, the actuaries tell you exactly how much to hold back based on the odds.
Exactly. MTG is forced to lock away capital, assuming a certain percentage of homeowners will default on their mortgages. But when the storm isn't as bad as you thought, when people actually keep paying their mortgages, you get to take that cash out of the vault and put it right back into your wallet.
Which drops straight to the bottom line as pure profit. That $31 million was previously trapped capital.
Right. So why is it dropping? Why are people not defaulting when inflation is supposed to be crushing everyone?
Well, what's fascinating here is that credit normalization is actually going incredibly smoothly.
Smoothly, despite the macro environment.
Yeah, the CFO Nathaniel Coulson made a huge point about this during the Q&A. Analysts were digging, trying to find weakness. They asked if certain regions were blowing up or if newer mortgages from 2023 were failing.
Because, I mean, if you bought a house in 2023 at 7%, you're stretched thin.
You'd think so. But Coulson explicitly said they're seeing no geographic deterioration. None. And there's no vintage divergence in delinquencies either. The newer loans are behaving just as predictably as the older ones.
Wow. So the consumer's just stubbornly holding on.
Holding on tight. But, while that $31 million is great, it's not actually the biggest driver of the story for Q4.
Oh, then what is the biggest driver?
The absolute masterstroke of this quarter was what MTG did with their reinsurance program.
Okay, yes. We have to talk about the reinsurance treaties.
Yeah.
This is where the Wall Street jargon gets super dense.
It does. But let's translate it into plain English. Reinsurance is just MTG paying other massive global companies to share some of their risk. So if housing collapses, MTG doesn't go bankrupt alone.
Right, they lay off the risk. So what did they actually execute this quarter?
3 massive moves. First, they executed a $250 million excess of loss transaction for their 2021 policies.
Meaning, if things get really catastrophic with the 2021 vintage, the reinsurer covers the next $250 million in losses.
Exactly. It caps their downside. Then they set up a 40% quota share for 2027.
Wait, 2027? They're already planning for 2027.
Yep. They're locking it in early. A quota share means the reinsurer takes 40% of the premiums, but also pays 40% of the claims from $1.
Okay, so that frees up their own capital today. But what was the third move?
This is the genius part. They went back and renegotiated their existing 2022 treaties.
They just went back and asked for a better deal.
Yeah. Because the 2022 policies are performing flawlessly, the risk hasn't materialized. So MTG basically told the reinsurers, look at the data, you're overcharging us for risk that doesn't exist anymore. And they secured a massive discount. They cut their ongoing costs for those treaties by roughly 40%.
A 40% cut? Wait, really?
Starting in 2026, yeah. They just engineered a massive margin expansion out of thin air.
Oh, wow. That is incredible. And because of those slashed reinsurance costs, that perfectly pivots us into management's guidance for 2026, because you can immediately see the impact in their operating expenses.
Yeah, the OpEx guidance is super telling.
Right. So getting back to the data forward delivery here. Management projects that their OpEx is going to drop down to a range of $190 million to $200 million for the year.
And that's down from their previous estimates, right? Which were hovering around $195 to $205 million.
Exactly. They are literally crushing their own corporate overhead because the reinsurers are basically subsidizing them now through lower costs and higher ceding commissions.
It's just a highly optimized machine at this point.
It is. But then you look at the revenue side of the guidance. They expect premium yield to stay relatively flat, right near 38 basis points.
Which is good. It means they aren't getting dragged into some destructive price war with competitors.
True. Holding the line on pricing is key.
Yeah.
But here's the part of the guidance where I really need to push back.
Let's hear it.
Crucially, management said that they expect their total insurance in force, the overall size of their pie, to remain relatively flat in 2026.
Yeah, that caught a lot of people off guard.
Wait, earlier in the year, they were talking about ongoing growth, adding new milestones, and now they are projecting a completely flat portfolio. I mean, why should an investor care about a company that isn't growing its pie?
Well, if we connect this to the bigger picture, the macro reality, it's actually not a failure. It's just brutally honest math.
How so?
Well, look at the elevated mortgage rates. Less people buying homes means fewer origination forecasts across the board. They can't invent home buyers.
But what if rates drop? Wouldn't that trigger massive growth?
This is the brilliant catch-22 that management noted on the call. If rates drop significantly, yes, the total mortgage market grows because tons of new people rush in to buy.
Right.
But simultaneously, everyone who bought a home at 7% last year is going to instantly refinance.
And when they refinance, the old PMI policy gets canceled.
Exactly. MTG's persistency rate would plummet, so the massive wave of new policies coming in the front door would be totally canceled out by the old policies rushing out the back door.
That is a wild catch-22.
It really is. So flat is actually a realistic, disciplined forecast. It's not them giving up. It's just the structural reality of the industry right now.
Okay, that makes perfect sense. And that brings us to the bottom line. This is where we demand the final verdict for you, the listener.
The moment of truth.
Exactly. Taking all of this into account, the flat growth, the reinsurance masterstrokes, the frozen market, is this a bullish or bearish signal for a retail investor who's either holding or considering buying MTG stock?
Okay, I'm going to take a firm, highly opinionated stance here.
Do it.
It is an incredibly bullish signal.
Even with flat growth?
Yes, but with a caveat. It is bullish specifically for value and income investors, not growth speculators.
Right. If you want explosive top-line revenue, look somewhere else.
Exactly. But the reason it's so bullish for value investors comes down to one thing: massive, aggressive capital returns.
Let's hit the data on that, because the proof here is just staggering. In 2025, MTG returned $915 million to shareholders through buybacks and dividends.
Just think about that scale. They only made $738 million in net income.
Right. They are returning more cash than they actually earned in profit for the year. And by doing that, they wiped out 12% of their outstanding shares.
12% of the entire company retired in 12 months. It mathematically forces your slice of the pie to become larger without you spending a dime.
It's a relentless tailwind for earnings per share. And they are not stopping. In January of 2026 alone, they already bought back another 2.7 million shares for $73 million.
Because they have the capital to do it. They are a cash-generating fortress right now. They've got $1 billion in holding company liquidity, and down at the operating level, they have $2.5 billion in excess to their PMIers requirements.
Which is their regulatory cushion. They are bulletproof.
Yeah.
So, translating this into the final actionable takeaway for you. You don't buy MTG right now for explosive top-line revenue growth. That's just not going to happen in this macro environment. You buy it because management is relentlessly defending their margins. They are slashing risk through these brilliant reinsurance deals, and they're buying back their own stock at a furious pace.
It's an absolute masterclass in capital allocation.
It really is. So we want to thank you for taking this rapid-fire deep dive with us today.
Yeah, thanks for joining.
But as always, before we go, we want to leave you with one final lingering question. Something to chew on based on the risks discussed in the Q&A.
Right, because no fortress is perfect.
Exactly. Management explicitly called out housing affordability as an ongoing challenge. And on top of that, analysts were really probing the looming threat of FHA premium reductions.
Yeah, the government could just step in and slash prices on FHA loans to force affordability.
Right, and if they do that, it undercuts the private market completely. So the question for you to keep a close eye on in 2026 is this. How long can private mortgage insurers like MTG rely on financial engineering and stock buybacks before the sheer cost of buying a home starts to permanently shrink their addressable market?
It's the big existential question.
It truly is. Something to watch very closely. Thanks again for joining us, and we'll see you on the next deep dive.